Okay, let's unpack this. Welcome back to the deep dive.
It's good to be here.
This week we are looking at a pretty intense stack of source material. We've got economic reports, we've got critiques from the big banks, and some major geopolitical news, and we're trying to synthesize all of it into a single mission.
Right, and that mission is really trying to understand if Canada is genuinely prepared for the turbulence that's clearly on the horizon for 2026.
It really feels like a collision of forces.
It's the perfect way to describe it. Profound collision. Because, domestically, you have this incredibly ambitious, almost heroic push from the government to try and fundamentally reshape Canada's entire investment landscape.
But then externally.
Externally, you've got these sudden, dramatic geopolitical shockwaves and looming trade deadlines that, honestly, could completely redefine the country's economic sovereignty.
And our sources today are really providing that crucial counter-narrative to let's say, the official government line. We're pulling from critiques from Canada's largest financial institutions, TD, Scotiabank, National Bank, and we've got detailed reports from Deloitte, various market analysts.
And they're all asking the same fundamental question we are.
Which is?
Is Canada's massive investment goal even achievable? Or is the country just too hampered by, all this structural friction, both at home and abroad, to finally break out of this low-growth cycle we seem to be stuck in?
Let's start with that cycle. The foundational problem, you said, is this low-growth environment.
Exactly. I mean, look, Canada did successfully avoid a full-blown recession last year, and we have to give credit where it's due.
Right. We dodged a bullet.
We did. But the forecast for 2026 remains just sluggish.
Yeah.
Stubbornly so. And the Bank of Canada has been warning about this for a while. They call it a vicious circle.
A vicious circle of what?
Of weak productivity. It drives down business confidence. That, in turn, leads to reduced investment. And what does reduced investment do? It further impairs productivity. It's a feedback loop.
And breaking that specific loop is the whole game.
It's the key to Canadian prosperity, yes.
Okay, so to break that cycle, Prime Minister Mark Carney has put a stake in the ground. He's thrown out a headline-grabbing figure.
A huge figure.
A huge figure. The goal of attracting a total of 1 trillion Canadian dollars in public and private investment over the next 5 years.
1 trillion Canadian dollars. It's an incredible number.
And this capital injection is supposed to be activated through tax incentives, targeted spending on, all the key sectors: housing, infrastructure, green energy, defense. That number is the massive, looming benchmark for success or failure in Ottawa right now.
And that benchmark is precisely where our source material starts sounding the alarm. Immediately.
Because it's too ambitious.
It's breathtakingly ambitious. When economists actually run the numbers on that 1 trillion Canadian dollar figure, they conclude that to hit that target, Canada would need to nearly double its current annual rate of investment.
Double it. Over 5 years. I mean, that doesn't sound like a policy goal. That sounds like you're wishing for a miracle.
Well, you're not alone in thinking that.
Yeah.
The skepticism is, it's widespread. Jean-François Perrault, he's the chief economist at Scotiabank, he called the 1 trillion Canadian dollar target completely unrealistic.
That's a pretty blunt assessment from a major bank.
Very blunt. But to be fair, he wasn't entirely dismissive. He did concede that, look, even partial success, hitting a third or maybe half of that target, that would still benefit the country immensely.
Of course.
But the point remains. When you set a benchmark that requires a 100% increase in performance, you're fundamentally framing the entire policy effort around potential failure. At least, unless you address the deep structural issues first.
Right. It's like, if you set a goal of climbing Mount Everest, but you haven't bought any climbing gear and the base camp is already on fire, you have to address the immediate problems first.
A perfect analogy.
So our mission in this deep dive is to really explore that friction. The things that make that 1 trillion Canadian dollar goal so incredibly difficult to reach.
Exactly. And we need to look at both sides of it. The internal friction, things like the tax system, and the external friction, those big geopolitical shocks.
Okay, let's start with the domestic side then. If the government is actively trying to push for this massive capital flow, what are the primary internal roadblocks that Canada's leading economists are flagging? What's stopping businesses from feeling confident enough to actually deploy their cash?
The diagnosis is pretty much unanimous from the banks. They all say that budget investments alone, even really large targeted spending packages, they just won't move the competitiveness needle enough.
So throwing money at the problem isn't the solution.
Not on its own, no. They argue that what's necessary is comprehensive, bold tax reform. The problem isn't necessarily a lack of government spending. It's the fundamental structure of the system itself, a system that, kind of discourages growth in the first place.
So it's not a money problem. It's a structural disincentive problem. That's a really crucial distinction. What's the most cited example of that in the reports?
It comes down to the tax treatment of small businesses.
Hmm.
It creates something that Beata Caranci, the chief economist at TD Bank, she vividly described it as the bunching effect.
The bunching effect. What is that?
So in Canada, businesses get to benefit from these highly preferential, lower corporate tax rates, but only up until they hit 500,000 Canadian dollars in taxable income.
Okay, I'm with you so far. So what happens when a firm scales up and passes that $500,000 benchmark?
That's the trap. As soon as a firm crosses that $500,000 line, the effective tax rate jumps up significantly. It creates a substantial fiscal penalty for expansion.
And that's the bunching.
That is the bunching. Economists can actually see it in the data. They observe that many successful growing firms intentionally stop scaling up, or they bunch their reported taxable income right at that $500,000 threshold.
So let's put this into a concrete scenario for you, the listener. Let's say you own a software firm. You're consistently making, I don't know, $450,000 a year in profit, and you're enjoying that low tax rate.
Right.
Then you get an opportunity. You could invest in a new product line that would push your profit up to $600,000. But if that extra $150,000 in profit suddenly subjects your entire profit pool to a much higher tax rate,
The owner might just look at it and say it's not worth the hassle.
it's not worth the regulatory headache or the tax hit to grow.
That is precisely the disincentive. They're actively choosing to remain small and stable rather than maximizing their profit growth and, by extension, employment. They're doing it because the current tax structure actually punishes them for scaling up.
And Caranci argued this is happening at exactly the worst time.
At the most crucial moment. This is when these small enterprises should be transitioning into medium-sized drivers of productivity for the whole economy, and instead, they're being stunted.
So what's the minimum fix the economists are asking for to address this specific piece of friction? It sounds pretty serious.
It's surprisingly simple, actually. It's indexing,
Just tying it to inflation.
just tying it to inflation. They recommend that, at a minimum, that 500,000 Canadian dollar threshold should be indexed to inflation. This would just allow the threshold to keep pace with economic realities. It would stop penalizing success simply because a business is generating the same real dollar profit it was a decade ago.
Indexing seems like a total no-brainer if the government is genuinely serious about attracting 1 trillion Canadian dollars. But the critique goes beyond just small business taxes, doesn't it? It feels broader.
Oh, it is. It's about the overall perception of the entire environment. Jean-François Perrault at Scotiabank, he confirmed this widespread sentiment. He said, businesses are generally not trying to maximize profit growth because their view of the overall tax system and the broader regulatory environment is that they constitute serious disadvantages.
Disadvantages compared to where?
Compared to operating and scaling up in other jurisdictions, like the U.S., for example.
So when Prime Minister Carney makes a policy announcement, let's say it's a corporate tax adjustment or some targeted spending program, how do our sources interpret those actions? Are they seen as genuine, bold reform?
Not entirely, no. Beata Caranci pointed out that a lot of Carney's recent corporate tax changes were actually inherited. They were policies from the previous government. They were just unwinding earlier, less successful policies.
So it's more like cleanup than new construction.
Exactly. She said that what the government has done so far is mostly unwind previous bad policy. It's not the kind of structural, pioneering tax action that you'd need to achieve a goal as monumental as attracting 1 trillion Canadian dollars in new investment.
The perception, then, is that they're just clearing up old messes rather than charting a truly new competitive course for the country.
That's the view from the banks, yes.
Okay, that makes the task of finding that 1 trillion Canadian dollars even harder. If businesses aren't motivated by the tax structure, the government needs to find a massive pool of capital that's already motivated, or one that can be more easily guided.
And that brings us directly to domestic pension savings.
Right, and this is where we go from friction to paradox.
A huge paradox. Because, Canada has one of the world's largest, most sophisticated pension systems. And right now, governments all over the world, not just in Canada, but also the UK, the Netherlands, they're all putting immense pressure on these enormous pools of capital.
Pressure to do what?
To channel those savings toward domestic needs. Things like technology, defense, green energy, infrastructure. It's seen as a kind of fast track to jumpstart national growth without having to rely solely on tax cuts or taking on more debt.
The UK example in the source material is particularly aggressive on this front. What exactly is Chancellor Rachel Reeves trying to do over there?
Reeves is trying to push roughly 80 billion pounds into what they're calling productive assets. And the explicit goal is to see about half of that, so 40 billion pounds, flow domestically into UK projects.
How are they making that happen?
Well, to encourage it, ministers coordinated what they call a voluntary agreement with 17 of the largest defined contribution providers. They've been asked to invest a minimum of 5% of their assets in UK private markets by the end of the decade.
That sounds like a polite request, but our sources indicate the UK government isn't just relying on good manners here.
Not at all. There's a threat behind the request. If these funds fail to honor the so-called voluntary commitment, the government is introducing legislation that will empower regulators to mandate a minimum amount of investment into private assets.
So they're moving from encouragement to potential compulsion.
That is the crucial point, yes.
And that brings us to the core conflict that's raging globally right now, this pension paradox. How do the funds defend their independence against these kinds of national economic mandates?
Their defense centers entirely on one concept: fiduciary duty.
The legal obligation.
The legal and ethical obligation of a trustee to act solely in the best interests of the beneficiaries. In this case, the pensioners and the savers. And pension fund executives, they fear that mandatory domestic investment, especially into unproven or, politically directed projects, could seriously hit their returns.
And if returns are hit, that could disincentivize saving altogether.
That's the ultimate fear. What's the practical consequence if a fund compromised its fiduciary duty to invest domestically? Well, if the fund invests locally and those investments underperform global benchmarks, the trustees could be legally liable.
And more importantly,
millions of ordinary people nearing retirement would see their life savings compromised. Sir Steve Webb, who was a former UK pensions minister, he summarized the industry's position perfectly. He stated, very bluntly, that the money in people's pensions should not be a plaything of governments.
that's a strong quote. It really implies that national economic planning should not supersede an individual's right to retirement security.
Absolutely. It gets even stronger. Charlie Nunn, who's the CEO of Lloyd's Banking Group, he characterized the idea of compelling asset allocation like this as a form of capital control. He warned that this kind of compulsion puts the entire financial ethos of an open economy on a difficult slope.
Okay, so let's bring this home to Canada. The largest pool of that capital is held by the CPPIB, the Canada Pension Plan Investment Board. For you, the listener, who relies on your Canada pension plan, what exactly is the CPPIB's mandate?
The CPPIB manages the funds for the Canada Pension Plan. Their job is to ensure its long-term sustainability for generations, and their stated legal mandate, as confirmed by their own CEO, is to maximize return without undue risk of loss.
So they have to seek the highest return globally for the benefit of future Canadian retirees, not just in Canada.
Globally, yes, that's their duty.
And just to give a sense of scale, how large is this fund?
It's massive. Its total asset size stands at a staggering $714 billion US dollars.
Wow.
And yet, despite all this domestic pressure, the CPPIB's actual allocation to Canadian assets has been shrinking. It fell to only 12% this year, and that's down from 14% just 2 years ago.
Now, 12% of a fund that size is still a monumental investment in Canada. But the fact that the trend is moving away from Canada, even as the government is desperately pushing for that 1 trillion Canadian dollar goal, that's very telling, isn't it?
It is. It suggests the government's efforts haven't yet created the kind of compelling large-scale opportunities that meet the fund's strict risk-return profile.
And the CEO of CPPIB essentially confirmed this.
He did. John Graham, the CEO, he said he was super encouraged by Prime Minister Carney's efforts to create large investable projects, but then he immediately cited the critical blockage. There is currently an opportunity deficit.
An opportunity deficit. That's a very diplomatic way of putting it.
It is. He affirmed that they will invest more if we see opportunities, but only within their mandate to maximize returns.
It sounds like the government is acting as the developer, creating the plans for all these housing and infrastructure projects, but the CPPPA is acting as the venture capitalist, demanding proof of profitability and de-risking before they'll write a check.
That's the perfect way to frame it. And, to Ottawa's credit, they are trying to tackle that de-risking part. They've taken some concrete steps to try and court this pension capital.
Such as?
Well, they prioritized local products for government procurement. More importantly, in December of 2024, they removed the 30% cap on ownership of Canadian entities that these funds could hold. That was a big deal.
And they've also addressed the perennial killer of any large-scale infrastructure investment,
Right.
regulatory uncertainty and bureaucratic drag.
Absolutely.
Yeah.
They established the Major Projects Office, or MPO. The entire point of the MPO is to fast-track national infrastructure projects, to reduce the uncertainty that's inherent in these huge, multi-year complex programs.
So the government recognizes that if they can dramatically cut the timeline and the regulatory risk, they might be able to inspire the private sector, including the CPPB, to finally bridge that perceived opportunity deficit.
That's the hope.
Okay, so we have the Canadian government trying to manufacture domestic investment opportunities while simultaneously wrestling with its own pension giants over fiduciary duty and a crippling tax structure that discourages growth. That's the domestic struggle for the 1 trillion Canadian dollars. But now we have to talk about external forces that are, well, vastly more chaotic.
Yes.
Let's pivot to the U.S. intervention in Venezuela and the capture of President Nicolas Maduro.
This geopolitical shockwave is, I think, perhaps the most immediate and disruptive factor for Canada's entire economic outlook. The military action and the capture of Maduro, it stunned global markets.
Oh.
And the fallout immediately impacts Canada's most vital export sector, energy.
And Venezuela is key here because it holds the world's largest known exploitable oil reserves. But it's not just the size, it's the type of oil, correct?
Precisely. Venezuela's oil is heavy crude. This means it requires the exact same highly specialized refinery processing capabilities that Alberta's bitumen demands.
So if Venezuelan oil suddenly floods the market,
It's in direct, immediate competition with Canada's heavy crude exports, primarily coming out of Western Canada.
and the U.S. administration wasted absolutely no time asserting control over this vital resource.
None whatsoever. The U.S. Energy Department, they quickly issued statements asserting indefinite control over Venezuelan oil sales worldwide. They insisted that all sales must be consistent with U.S. law and go through U.S.-approved channels.
And they didn't stop there.
No. The administration also announced plans to immediately sell off 30 to 50 million barrels of seized oil just to inject supply into the global market. And all the proceeds from that sale are being channeled into U.S.-controlled accounts at globally recognized banks.
This action signals the U.S. isn't just sanctioning a country anymore. It's effectively taking over the governance of its primary export market. That is a dramatic move.
It redefines international energy dynamics overnight. And adding to the drama was the immediate crackdown on what's known as the shadow fleet.
The Shadow Fleet. This is the network of vessels used for smuggling sanctioned oil, right?
Exactly.
Yeah.
From rogue states like Russia, Iran, and Venezuela, the U.S. seized multiple sanctioned tankers, including two called the Bella One and the M. Sophia.
The details on the M. Sophia seizure are worth dwelling on for a second, just to emphasize the scale of this illicit trade.
Well, the M. Sophia was caught carrying about 1.8 million barrels of crude oil. At current market prices, that single cargo was worth approximately $108 million US.
$108 million on one ship.
On one ship. To put that figure in context for you, that is roughly the equivalent of the annual operating budget for a mid-sized Canadian city.
Wow. And the source mentioned the Bella One tried to evade capture.
It did. The U.S. Coast Guard pursued the Bella One, which had been renamed the Marinera, and had a Russian flag hastily painted on its hull in just a blatant attempt to evade the blockade. This isn't just policy. It's high-stakes maritime policing on the open seas.
So what was the direct consequence for Canada's oil patch when this news broke?
Immediate volatility. Prices for Canadian heavy oil grades, they just tumbled following Maduro's capture. Now, Piata Caranchi at TD Bank rightly noted that truly unlocking Venezuela's full oil potential will take years and a massive investment. The sector has been ravaged by corruption and disrepair.
Right.
But the existing global supply glut and the sudden fear of a potential flood, that's the immediate concern for Canadian producers.
And this external threat has predictably fueled a lot of domestic political urgency around energy security and diversification.
Absolutely. It just underscored Canada's vulnerability given our overwhelming dependence on the U.S. as our primary export market.
Yeah.
Stéphane Marion, he's the chief economist at National Bank, he used the moment to urge for greater speed on infrastructure. He said Canada needs to be a little bit more aggressive in terms of building it pipelines, and hopefully we can do it in less than 10 years.
And the opposition leader, Pierre Poilievre, he immediately seized on this, urging Prime Minister Carney to immediately approve a pipeline to the Pacific coast. The goal being obvious: diversify away from the new reality being imposed by Washington.
The urgency is magnified because this Venezuelan crisis, it moves beyond mere economics. It raises these fundamental questions about Canadian sovereignty and the very nature of our relationship with our largest, and now it seems highly unpredictable, neighbor.
This is where it gets really interesting and, frankly, a bit unsettling. This successful unilateral U.S. intervention, challenging international norms to secure its energy interests. It seems to have emboldened voices that have previously threatened Canada directly.
That's the consensus among the geopolitical analysts and our sources.
Hmm.
I mean, we all know that the previous U.S. administration, led by former President Trump and his officials, they have openly talked about annexing Canadian territory.
Right, along with those threats aimed at the Danish territory of Greenland.
Exactly. And one analyst, Eric Ham, he explicitly called the Venezuela invasion a clear warning shot to Canada.
A warning shot about what, exactly?
It suggests that if a country has resources that the U.S. deems critical, and if the U.S. decides that country's leadership is, I don't know, unstable or inconvenient, then military or economic unilateralism is an option on the table, regardless of international law or allied status.
And how did our allies react?
Well, France and Denmark were quick to issue diplomatic statements insisting on respect for national sovereignty following Maduro's capture. But Canada's official statements, they were viewed by some analysts as walking a very careful diplomatic tightrope, speaking generally about supporting international law rather than issuing any kind of firm condemnation.
And this highlights the immense pressure Canada faces.
It does. Jean-François Perrault voiced a specific concern that Canada risks acting too slowly in response to this new reality, that we're squandering the urgency that we adopted after the last round of U.S. tariffs were imposed. His worry was specific, he said. As much as we want to seize the moment, that we don't.
The fear is that Canada will fail to use this geopolitical shock to fundamentally redefine its own energy and trade security.
Exactly. And beyond the energy and sovereignty questions, the Venezuelan crisis has these huge humanitarian and diplomatic repercussions, particularly concerning migration and the future of Cuba.
The migration component is already visible here in Canada, isn't it?
Yes, it is. Venezuelan asylum claims in Canada have been steadily rising since 2013. They hit a peak of over 3,000 referrals in 2023. And Canada's current policy is one of administrative deferrals.
Meaning we don't deport Venezuelan nationals?
Generally, no, not due to the ongoing humanitarian crisis. And while improved conditions in Venezuela could theoretically change this, the likelihood of continued instability suggests this policy of deferral is going to remain in place, contributing to our overall immigration numbers.
And then there's the knock-on effect on Cuba, which is potentially disastrous given Venezuela's role as its longtime economic lifeline.
Exactly. Venezuela has propped up Cuba's economy for years, mainly through subsidized oil shipments. Now, Cuba is on the brink of an even deeper crisis. It's already struggling with widespread blackouts and severe water shortages. David Carment, a professor of international affairs, he emphasized that Cuba is almost entirely dependent on energy imports from Venezuela.
And this puts Canada in an extremely awkward diplomatic position, doesn't it, given our economic relationship with Havana?
Deeply awkward. I mean, Canada is Cuba's second largest source of direct investment, and it's a major tourist destination for us. A former Canadian diplomat, Louise Blais, she suggested that while Ottawa's response to the Venezuelan situation was relatively straightforward because we didn't recognize Maduro, a similar U.S. intervention or hardline action against Cuba would leave Canada with, in her words, no place for us to hide.
Could be caught directly between our economic interests, our democratic values, and our massive geopolitical neighbor. This brings us to the core ethical question that Max Cameron, a UBC professor specializing in Latin America, raised. He asked, is the U.S. intervention actually about restoring democracy, or is it simply about securing oil?
And Cameron pointed out a very telling detail. The U.S. is partnering with Maduro's vice president, which potentially allows them to secure their oil interests without needing to fully restore any democratic processes.
Which forces Canada to confront its own foreign policy goals.
It does. Canada has historically supported human rights activists in Venezuela. And Cameron suggested that instead of being an accomplice to American actions that are driven purely by oil access, Canada should focus its diplomatic efforts on helping Venezuelans build up their democracy and their institutions from the ground up.
Geopolitical risks, like the Venezuelan shockwave, they feed directly into trade uncertainty. And nothing creates more economic uncertainty for Canada than the looming review of CUSMA, the Canada-US-Mexico Agreement.
The clock is ticking, loudly. The CUSMA framework is scheduled to be reopened on July 1, 2026. This review is absolutely pivotal because, as Deloitte's report noted, trade volatility played an unusually significant role in the Canadian economy last year.
And it masked underlying weakness.
It masked underlying softness in consumption and led to a big business pullback. Businesses hate uncertainty, and CUSMA's future is the very definition of uncertainty right now.
We should probably define why CUSMA, which of course replaced NAFTA, is so absolutely essential to Canada's economic survival.
It's a shield. It's our economic shield. The Bank of Canada reports that 95% of Canada's exported goods to the U.S. are CUSMA compliant. And because of that, they're not subject to the kind of punitive tariffs you see in trade disputes.
And for energy exports, that protection is even more complete.
100%. 100% of our energy exports rely on the CUSMA framework. Losing that protection would expose nearly the entirety of our primary export market to crippling, sudden tariffs. It would be devastating.
So even these modest growth forecasts we're seeing are entirely predicated on the expectation that CUSMA will remain largely intact.
Completely. Dawn Descardian, she's Deloitte's chief economist, she based her relatively muted 1.5% growth forecast on the critical assumption that Canada will maintain its favorable trading relationship and retain access to the U.S. market relatively tariff-free.
But that status quo assumption is key, and it's far from guaranteed, especially given that high-level trade talks collapsed just last fall.
And this is where we get to the absurd detail that shows how fragile this relationship truly is. Part of the reason for the breakdown in those high-level trade talks was reportedly linked to a single Super Bowl advertisement.
You're kidding me.
Nope. Specifically, an Ontario government ad that aired during the game featuring a clip of former U.S. President Ronald Reagan arguing against tariffs.
A Super Bowl ad featuring a clip of a deceased U.S. president is responsible for derailing critical international trade negotiations. That is a perfect, if terrifying, encapsulation of the instability we're facing.
It's volatility distilled into a 30-second spot. And the investment community, they recognize that this instability is corrosive. Market analysts are very clear. This elevated trade uncertainty will continue to constrain business confidence and capital investment. It's what's keeping overall GDP growth limited to an expected 1.2% for the year.
And it means that achieving that aspirational 1 trillion Canadian dollar investment goal is even more remote. Businesses are just holding on to their cash, waiting for clarity on their market access.
That's right. So when the macro picture trade, geopolitics, tax friction, when it looks this challenging, investors are forced to ignore the broad economic trends and focus intensely on individual company fundamentals.
They're looking for companies with resilient business models, strong balance sheets, and some degree of insulation from all these CUSMA and Venezuelan shockwaves.
Exactly.
Okay, let's zoom in now from those global shocks to the street level. Let's talk about the consumer and the housing market. In this climate of 1.2 to 1.5% expected growth, how are ordinary Canadians holding up?
We're seeing a classic K-shaped consumer trend. This means the economy isn't struggling uniformly. It's segmenting very sharply based on income level. It's creating this bifurcation of spending habits.
Okay. Can you explain that divergence and what it means for the retail sector?
Sure, at the high end, that's the top arm of the K. Higher income households are, generally speaking, doing fine. They have greater accumulated savings, and they're driving continued strength in discretionary sectors.
Like what?
Travel, luxury vehicles, high-end goods. Conversely, the bottom arm of the K consists of lower-income consumers, and they're facing persistent pressure. Their wages are tight, employment quality is a concern, and essential costs like housing and food are just crushing any discretionary spending they might have had.
So we're seeing them actively trading down.
We are. The reports are definitive. These consumers are choosing cheaper brands, they're delaying non-essential purchases, and they're reducing their basket sizes in retail.
So a luxury travel firm is healthy, while a discount grocer might be seeing increased volume, but their margins are getting squeezed due to price sensitivity.
Precisely. And this K-shaped environment creates specific bright spots for certain firms with resilient business models.
Let's dive deeper into the 3 firms that analysts seem to be favoring right now. Who's first?
First is Air Canada, which I know is a bit counterintuitive in a slow-growth environment. But analysts maintain an outperform rating and a $32 price target.
What's the rationale there?
The rationale is that they're structurally well-positioned to benefit from strong travel demand, which is primarily driven by the resilient spending habits of baby boomers and higher-income Canadians. People are still pursuing both international and domestic travel.
And they have new planes.
And they have new, more efficient aircraft being deployed, which is expected to expand their destinations. It provides a tangible new growth vector that isn't dependent on GDP alone.
Okay, second on the list. Atkins the major engineering firm. This seems like a direct beneficiary of the government's attempts to attract that 1 trillion Canadian dollars in infrastructure investment.
It benefits massively. Atkins is focused on infrastructure in both Canada and the U.S., so it's a beneficiary of government spending on both sides of the border, regardless of the trade tensions.
And their growth has been solid.
They've consistently demonstrated strong, high single-digit organic growth, and that trend is expected to continue given the decade-long infrastructure deficit we have. Analysts also expect more M&A activity, which has historically been a key part of their growth. And critically, their expertise in nuclear power is cited as a major, meaningful long-term growth driver as the world pivots back toward reliable, carbon-free energy.
Good point. And finally, NFI Group, the bus manufacturer. This seems like a pure play on support of public funding and maybe insulated from some of that trade risk.
It is a very strong industrial recovery play. NFI Group is expected to see strong earnings recovery because they have massive record backlogs. They benefit from highly supportive government funding for transit and clean energy vehicles. And crucially, their manufacturing capabilities span both the U.S. and Canada.
And that dual border exposure is key.
It's vital because it helps insulate them from the tariff risks and trade uncertainty tied to the CUSMA review. It just makes them a more predictable investment in a very uncertain environment.
Let's move from these specific investment opportunities to the broader Canadian obsession, real estate. Specifically Toronto, which experienced some high volatility last year. How is that market shaping up for 2026?
The Greater Toronto Area saw a meaningful market correction in 2025. Sales were down 11.2% compared to 2024, and at the same time, new listings jumped 10%. This combination finally allowed selling prices to drop.
Can you give us the hard numbers that quantify that correction?
Sure. The annual average selling price in 2025 was 1,067,968 Canadian dollars. This was a 4.7% drop from the prior year's average of 1,120,241 Canadian dollars.
And prices continued to fall at the end of the year?
They did. By December 2025, the average selling price had dipped further by 5.1% to 1,006,735 Canadian dollars.
So prices fell meaningfully. What do economists believe will be the catalyst to stabilize the market this year and encourage some of those hesitant buyers to get back in?
Rate certainty. That's the key. Economists expect the Bank of Canada to hold its benchmark interest rate steady at 2.25% throughout 2026. This certainty is what's needed.
So buyers who are waiting for the next rate cut might be out of luck.
One realtor, Tom Story, he noted that fixed mortgage rates are likely at their lowest point for a while, and that clarity is expected to prod hesitant buyers who've been sitting on the sidelines to finally jump back into the market.
But as you pointed out earlier, price drops don't always equate to improved affordability, not for the majority of buyers who actually need mortgages.
That remains the critical affordability caveat. While the price point saw a significant correction in 2025, the true cost of ownership, meaning the size of your monthly mortgage payment, that did not change as drastically. The debt service ratio is still punishing. So while Toronto's real estate board might claim improved affordability, those who need to finance a purchase still face substantial monthly payments that really strain their household budgets.
And what about the condo market specifically within Toronto?
The condo market remains soft. We're seeing falling prices, low sales volume, a glut of inventory, and even some project cancellations. So analysts are expecting downward pressure on resale prices to continue as the market just digests all the high inventory that accumulated during the volatility.
All right, let's shift quickly from residential to commercial. The high office vacancy rate has been this persistent post-pandemic drag on our city centers. Are we finally seeing any kind of reversal there?
Yes, and this is a genuinely positive data point. For the first time since the start of the pandemic, the national office vacancy rate actually dipped. It stood at 18% at the end of 2025, and that's down from 18.7% the previous year.
18% is still historically high, but...
But the fact that the rate is finally moving in the right direction signals a potential turning point.
What's fueling this net absorption? Is it purely the aggressive return to office mandates we've been seeing?
That's a major factor, yes. The accelerated return to office mandates, with big banks pushing hard, and the Ontario government even mandating 5 days a week for its employees. That's certainly driving demand. But there are two other structural factors helping out.
Okay.
First, new construction levels are at their lowest in 20 years, which is reducing the incoming supply. And second, there's been some inventory reduction. About 2.2% of inventory has been cut since 2021 through conversion to residential units or just plain demolition.
That's smart long-term city planning, taking older, less desirable office stock offline to tighten up the market. Where is this improvement most noticeable geographically?
Toronto is leading the resurgence. It's accounting for the vast majority of net absorption. 2.2 million square feet absorbed there last year alone. And that performance is strong enough to offset the negative absorption we're still seeing in struggling markets like Ottawa and Calgary. It's giving the national figure a lift.
Finally, before we synthesize all our findings, let's quickly touch on some personal finance advice that's relevant to this environment. Our sources highlighted some unique risks for single Canadians planning retirement, even for the most diligent savers.
This is a crucial area that's often overlooked in financial planning discussions. Retirement planning is inherently riskier for single Canadians because they lack several key financial advantages that are afforded to couples.
For example,
They don't have the ability to split eligible pension income, such as RIF withdrawals, after age 65. Splitting income can dramatically lower a couple's overall tax bill.
and beyond income splitting, they also lose out on basic tax efficiency, correct?
Exactly. They have fewer family status-based tax credits. They can't pool tax credits for large intermittent expenses like charitable donations or significant medical costs. On the savings side, they lack the flexibility of spousal RRSP contributions. And most defined benefit pension plans only include survivor benefits for a spouse.
And there's an emotional and logistical cost, too.
A huge one. They lack the anticipated, unpaid caregiving support that a partner often provides during periods of serious illness or decline.
So given all these inherent disadvantages, what is the single highest priority strategy for a single Canadian who is looking to secure their retirement savings right now?
Financial advisors are unanimous on this. The highest priority is maximizing any employer group RRSP matching programs. This is quite simply free money, and passing it up is a massive, massive missed opportunity.
And after maximizing the match,
After that, if your yearly income is over 60,000 Canadian dollars, prioritizing contributions to your RRSP often makes the most sense. It immediately reduces your taxable income in the present year. And then you can use the resulting tax refund to contribute to your tax-free savings account, or TFSA.
okay. This deep dive has really spanned the full spectrum of the Canadian economy. We've gone from the micro details of TFSA optimization all the way to the macro shocks of international military intervention. Let's bring it all back together now and recap the three deeply interconnected challenges Canada faces in its pursuit of that 1 trillion Canadian dollar investment goal.
The first challenge is domestic, and it's structural. There is a recognized urgent need for fundamental tax reform. That means addressing issues like the small business bunching effect and indexing the thresholds. We need to remove that friction to stimulate productivity. Without bold structural action, that 1 trillion Canadian dollar goal remains, as one economist put it, completely unrealistic.
The second challenge involves the massive pools of existing capital. There is this acute global tension between the fiduciary duty of pension funds, their duty to maximize returns for savers, and the national interest, which is demanding domestic infrastructure and innovation investment. And this has created that opportunity deficit that Ottawa is struggling to fill, despite regulatory concessions and setting up the Major Projects Office.
And the third and most chaotic challenge is all the external volatility. Canada is facing a crucial CUSMA review deadline in July 2026, which continues to constrain investment. And alongside that, you have the immediate economic and diplomatic shockwave from the U.S. intervention in Venezuela, which has depressed heavy oil prices and raised these profound, uncomfortable questions about Canadian sovereignty.
So what does this collision of domestic friction and external chaos mean for the year ahead?
The overall forecast is cautious. It's muted. It's predicting slow growth hovering somewhere between 1.2 and 1.5%. And the sources are very clear on this. This modest growth is entirely dependent on two major variables holding steady.
And those are
First, the CSMA trade status quo has to be maintained. And second, the government's infrastructure and investment projects have to be successfully executed, which means they have to somehow overcome that opportunity deficit cited by major domestic investors like the CPPAB.
So, in short, Canada is relying on its big challenges not getting any worse, while hoping its internal reforms suddenly start working much, much better.
That's a good summary of a very precarious situation.
If the U.S. action in Venezuela is truly a warning shot, as the analyst suggests, what's the ultimate thought we should be leaving the listener with about Canada's ability to navigate this new era of superpower unilateralism?
You have to consider the sheer scale of the instability that we've just mapped out. We've seen the U.S. intervene militarily in an oil-rich nation. We've seen it assert indefinite control over that nation's resources globally and seize assets on the high seas. All while Canada's economy is highly dependent on access to that same superpower's market through a trade agreement that is up for review in just a few months.
You heard the concerns that Canada is squandering the urgency it adopted after the last round of U.S. tariffs.
And this raises a critical question that you, as you listen, must carry forward into your own planning. How effectively can the Canadian government leverage international law and diplomatic pressure to secure its own core interests? Be that securing energy export markets or ensuring democratic stability when its largest partner is actively defining a new global norm. A norm that says unilateral force and economic coercion are acceptable tools, even against allies.
It suggests Canada's economic and political destiny is now.
It suggests it is now irrevocably tied to our ability to manage a major neighbor that increasingly operates outside of traditional international norms. That is the new, pervasive layer of instability that you have to factor into every long-term decision you make.